You've heard of Bitcoin, right? Ethereum? Dogecoin? Maybe, hopefully not. They're all cryptocurrencies. Digital money that lives on the internet. But where do you get them? How do you trade them? Enter crypto exchanges. Think of these exchanges like stock exchanges. But instead of Apple or Tesla, you're buying and selling digital coins. They're the bustling marketplaces of the crypto world, connecting buyers and sellers 24/7. No sleep, just gains, hopefully. Why should you care? Because crypto is becoming a big deal. It's not just for tech nerds anymore, and if you want to dip your toes into this world, understanding exchanges is step one. But hold up, not all exchanges are created equal. There are two main flavors, centralized and decentralized. And trust me, they're as different as a five-star hotel and a tent in the woods. Let's break it down. Centralized exchanges, or CEX, are like the big banks of the crypto world. They're run by companies, have customer support lines sometimes, and offer a familiar, user-friendly experience. Think Coinbase, Binance, Kraken. These are the heavy hitters. Here's how they work. You create an account, verify your identity, thanks government regulations, link your bank account, and boom, you're ready to buy, sell, and trade crypto. They act as the middleman, holding your funds securely, again, hopefully, and facilitating transactions. The upside? CXs are generally easy to use, especially for beginners. They offer a wide variety of cryptocurrencies, have high liquidity, meaning you can easily buy and sell without crazy price swings, and often provide additional features like staking or lending. But here's the catch. You're trusting a third party with your crypto. Remember those banks we talked about? Yeah, they're not exactly known for their stellar track record when it comes to security breaches or shady practices. And with CEX, the risk is real. Hacks happen, and when they do, it's not pretty. On the other side of the spectrum, we have decentralized exchanges, or DEX. This is where things get interesting and a little bit Wild West. DEX are built on blockchain technology, the same tech that powers cryptocurrencies themselves. This means there's no central authority, no company calling the shots. It's all peer-to-peer, baby. Instead of relying on a third party, DEX use smart contracts, basically self-executing contracts written in code to facilitate trades. This means you're always in control of your funds. No middlemen, no funny business. Sounds great, right? Well, it depends. DEX offer unparalleled security and privacy. Since you're not handing over your crypto to anyone, it's much harder for hackers to steal it. Plus, you often don't need to go through any KYC, know your customer procedures, keeping your identity under wraps. But here's the trade-off. DEXs can be intimidating for newcomers. The interfaces are often clunky. The trading volume can be low, and the fees can be higher than CEXs, especially during times of network congestion. It's not exactly a walk in the park. Centralized versus decentralized, picking your fighter. So which one should you choose? It's like asking if you prefer pizza or tacos. It all comes down to your personal preferences and risk tolerance. Centralized exchanges are your go-to if you prioritize ease of use, a wide selection of cryptocurrencies, and high liquidity. They're like the reliable, if slightly boring friend who always picks up the phone. Decentralized exchanges, on the other hand, are for the crypto cowboys and cowgirls out there. They offer unmatched security, privacy, and control over your funds. It's like riding a wild stallion. Exhilarating, but not for the faint of heart. Ultimately, the best choice depends on your individual needs and trading style. Do your research, weigh the pros and cons, and choose wisely, my friends. Real-world showdowns. Binance versus DYDX. Let's bring this battle to life with some real-world examples. In one corner, we have Binance, the reigning champion of centralized exchanges. It's like the Amazon of crypto, offering a vast selection of coins, a user-friendly interface, and a suite of additional features. But it's also faced its fair share of controversy, from regulatory scrutiny to security breaches. In the other corner, we have DYDX, a rising star in the decentralized exchange arena. Built on the Ethereum blockchain, DYDX offers a secure and private way to trade crypto derivatives with leverage. It's gaining traction among experienced traders who value control and transparency. This matchup highlights the key differences between centralized and decentralized exchanges. Binance offers convenience and a wide selection, while DYDX prioritizes security and decentralization. It's a classic battle between usability and control. Your keys, your crypto, or not. Privacy is a big deal in the crypto world. After all, one of the main appeals of blockchain technology is its ability to give individuals control over their own data and finances. But when it comes to exchanges, privacy can be a slippery slope. Centralized exchanges require you to jump through KYC hoops, handing over your personal information to a third party. While this is often done in the name of security and regulatory compliance, it does raise concerns about data privacy and potential misuse. Decentralized exchanges, on the other hand, often allow you to trade anonymously. Since there's no central authority collecting your data, your privacy is better protected. However, it's important to note that even on decentralized exchanges, your trading activity can still be visible on the blockchain, which is a public ledger. So, if you value privacy above all else, decentralized exchanges are the way to go. But if you're comfortable with sharing your information and prioritize convenience, centralized exchanges might be a better fit. The future of trading, a crystal ball full of blockchain. What does the future hold for centralized and decentralized exchanges? It's hard to say for sure, but one thing's for certain: the crypto landscape is constantly evolving. Centralized exchanges are likely to remain popular, especially among mainstream users. They offer a familiar and user-friendly experience, and their deep liquidity makes them attractive to both retail and institutional investors. However, they'll need to address concerns about security, transparency, and regulatory compliance to maintain trust. Decentralized exchanges, while still in their early stages, have the potential to disrupt the traditional finance world. As blockchain technology matures and scalability issues are addressed, decentralized exchanges could become the go-to platforms for traders seeking security, privacy, and control over their assets. Ultimately, the future of trading is likely to be a hybrid model, with both centralized and decentralized exchanges coexisting and catering to different needs and preferences. The key will be finding the right balance between usability, security, and decentralization.